Hello and welcome to another episode of Full Court Finance here at Zacks. I'm your host, Ben Rains. And today we're taking a look at 3 home run style renewable energy / EV stocks to consider buying that are trading for under $25 a share at the moment. And those 3 stocks are Rivian, Altus Power, and Livent. But before we get into everything, remember to subscribe and leave a review wherever you listen to your podcast, and make sure to check out our Zacks.com/promo page for a look into some of our services, portfolios, and more. And before we get into all 3 of these stocks we're going to look at today, I want to just kind of quickly go over where the market is. I'm recording this on midday Thursday, so we'll just kind of look at what's happened over the last several days and where we stand in terms of some technical views heading into the Fed's meeting next week. So Wall Street traders upped their bets that the Fed will pause at its September meeting next week following that CPI release on Wednesday, with the odds of a pause now at 97% versus 92% before the release. And this is according to the CME Fed Watch tool. And if we peek ahead, investors remain rather optimistic that the Fed is done hiking in 2023, though it's far less sure about what Powell and his peers will do at their November and December meeting, with traders currently pegging the Fed pausing at its next 2 meetings at around 60% versus 40% for a 25 basis point hike at either one of those meetings. So this came after core year-over-year inflation hit 4.3% in August versus 4.7% in July, with monthly core at 0.3% versus 0.2% in July. Inflation still obviously remains well above that 2% floating target for the Fed, and surging oil and gas prices are putting pressure on headline inflation and the wallets of Americans, at consumers and obviously companies as well, since oil and gas goes into so much of costs for businesses as well. For instance, monthly CPI hit 0.6% versus 0.2% in July, and a lot of that was those higher fuel prices. But the Fed focuses on core prices because its policy rates have far less sway over that area of the economy. And the Fed appears, as we said, ready to kind of hold firm at this point and see where the U.S. economy is and the labor market is in the early part of 2024 before they consider making their next move, which everyone's hoping will be lowering rates in their early months of 2024. So then on Thursday, we saw some August wholesale inflation, prices come in kind of hot, though core prices came in relatively as expected. So everyone should kind of be continuing to watch the S&P 500 and the Nasdaq and how they're interacting with their 21-day and 50-day moving averages. They've both kind of been hovering in between those levels, but with the positivity through midday on Thursday, with the Nasdaq up about 0.8% and the S&P 500 up a similar amount, they're both back above those 50-day moving averages again, heading into the Fed's big meeting next week. So that's kind of that line in the sand to pay attention to going forward. And then before we jump into these 3 stocks that we're going to look at today, in full disclosure, I want to say that I own all 3 of these stocks in the Zacks Alternative Energy Innovator Services, along with, at the moment, around 15 other stocks across various areas of alternative energy and renewable energy, the EV space. So we have nuclear, solar, hydrogen, and various other stocks. But these 3 are in the portfolio, so just want to let people know that. So the first up is Rivian Automotive, which trades in the ticker RIVN. The company is a U.S.-based EV maker, and it's ramping up production and cutting costs while rolling out some rather unique offerings compared to, say, Tesla and some other competitors in the EV space. And once again, like all of these stocks today, it's kind of a home run style play. So just that's the grain of salt you should take all of these stocks with. It's trading for around $24 a share at the moment and trading at a 50% discount in terms of forward earnings compared to Tesla. And overall, my opinion is that Rivian might be one of the best opportunities to buy in near the ground floor of an EV at these prices kind of ever again, as Tesla is already one of the biggest companies in the world, and all the other established automakers are ramping up and going all in on EV. And startup after startup in the U.S. is kind of falling by the wayside amid a really rigorous and CapEx heavy industry. So Rivian was founded over a decade ago, and the EV company remains at the start of its journey when it comes to actual production and sales and nearly everything else that goes along with that. The company pulled in only $55 million in revenue in 2021, delivering fewer than 1,000 EVs, but its sales skyrocketed to $1.7 billion in 2022 and it's boosting its production at its state-of-the-art manufacturing facility in Normal, Illinois, and its outlook is pretty impressive. So we're going to kind of jump into everything. So it's currently standing out by selling two main consumer-focused models that stand out compared to Tesla and others. Its EV pickup truck, which is the R1T, is pretty sleek but far less futuristic than Tesla's Cybertruck, which still isn't even on the road yet. So far more practical and kind of similar to the F-150 Lightning, but maybe I guess you'd call it a little sleeker and cooler. Meanwhile, its R1S, which is an SUV, is a real true sports utility vehicle compared to anything that Tesla is selling at the moment. So a lot more space. Looks more kind of like a bigger Jeep or something like that. Encourage anyone to go look up what these look like online. And then on top of that, the company makes a commercial EV van, and it made a splash back in 2019 when it announced a partnership with Amazon, which is a big investor, to bring 100,000 electric delivery vehicles to the road by 2030. The company still remains, or Tesla still remains, kind of the unquestioned leader in the space, grabbed 60% of the EV market share in the first half of 2023, yet Rivian's R1T, so that's the truck, came in fourth in terms of the top-selling EVs in the U.S. in the first half, behind only Tesla's Model Y and Model 3 and the Chevy Bolt. So it's doing well, and it's ramping up production quickly, as I said, and this puts it ahead of some offerings from Volkswagen, the Ford Mustang Mach-E, some offerings from Hyundai, two other Tesla models, and well above the Ford F electric series, so that's that Ford Lightning. Overall, global electric vehicle sales soared 65% in 2022, even as total new car sales dropped by about 1%. And EVs reportedly made up about 10% of all new vehicles sold globally in 2022. In the U.S., fully electric vehicles accounted for about 6% of all vehicles sold, up from just around 3% in 2021. And that figure was closer to around 1% as recently as 2019. So this leaves tons of long-term upside as everyone in the market chases the kind of growth industry, or the growth segment of the automotive industry, which is the EV segment. And they're taking advantage of the pro-EV policies in the US and elsewhere. Overall, various projections, including from Goldman Sachs, expect the overall market to expand from around 4% of the market in 2020 for EVs to nearly 50% of new car sales by 2035. So over the next 10 years, Rivian topped our quarterly earnings and revenue estimates back in early August, and it boosted its outlook. And it delivered roughly 13,000 EVs in the second quarter, up about 60% from the first quarter and 180% year over year. As I said, it's kind of starting from scratch still at this point, so its growth outlook is really impressive. And it boosted its 2023 production guidance by about 2,000 vehicles to 52,000 vehicles it's expected to produce. So really ramping up, but still really at the ground floor as well. The company also said its gross loss per vehicles are shrinking. It shrank by 35,000 last quarter, and it's producing more of its trucks and SUVs. It's also focusing on its new in-house battery packs and motors and improving its software. And then more recently, the company's CFO said that it will benefit from significant deflation in battery material prices at the end of 2023 and throughout 2024. And this could help with its push towards profitability and help boost its margins. So in terms of revenue, the company's revenue skyrocketed from $55 million in 2021 to about $1.7 billion in 2022, as we already mentioned. And then looking ahead, it's projected to post 161% sales growth in 2023 to get all the way up to about $4.3 billion, and then climb another 60% to $6.8 billion next year, which is quite a run from $55 million to nearly $7 billion in about 4 years. Meanwhile, it's projected to trim its adjusted loss from $6.34 per share to about $5 this year, and then cut that to a loss of around $3 per share, $2.92 in 2024. And it's topped our quarterly earnings estimates in the trailing 4 quarters. We should note that the company went public at a really inopportune time. It was trading, it spiked in its early days of trading to around $170 per share to make it one of the most valuable automakers on the planet at the time. But it started trading in early November of 2021, which is right when the Nasdaq peaked and the wave of tech and growth selling over the next year ensued. So the stock's down around 80% from its highs in the fall, coupled with its improving outlook. sets up kind of a potentially enticing entry point for investors who are obviously willing to take a risk on this kind of stock trading for this kind of level. So it's trading for, as I said, under $25 a share. It is up around 30% in 2023. And as of the moment, this includes an 80% climb since late June. And it completed that bullish golden cross in early August where the shorter dated moving average climbs above the longer term trend. And at the moment, as of Thursday afternoon, it's climbing right back above that 50-day moving average where it's been hovering for the last week or so. And it's far from overbought at the moment, even though it's had this nice run recently. And it's trading about 22% below its average Zacks price target. And as we said, 80% below its highs. And its impressive outlook mixed with its slide has it trading at about 3.6 times forward 12-month sales, which marks a 50% discount to Tesla. So that's a solid thing at the moment. Obviously, the company is burning through a lot of cash as it ramps up production in a very capital-intensive and complex industry. There are people who are really concerned that they're going to need to raise more money. Thankfully, the company might be able to take advantage of the renewed interest in its stock to help fund its growth efforts. That said, it currently has about $10 billion in cash and equivalents and about $2.3 billion in current liabilities. It is also rather heavily shorted, so that goes along with its home run style play. So just everyone needs to know this before they consider buying Rivian. But overall, it's certainly worth considering taking a look at this EV stock at this stage in its lifestyle, mixed with the compelling growth of its own business and the industry itself, and just the fact that all of these other players might just, if you're a startup now, it might be just too late to even get into the game as Volkswagen and Ford and every other established automaker ramps up its EV production. And once again, I own Rivian in the Zacks Alternative Energy Innovators portfolio. And next up is Altus Power, which trades on the ticker AMPS. The firm helps investors gain exposure to growing area of the solar market, which is commercial, industrial buildings, warehouses, and beyond. So the company's executives boast that it's a clean electrification company. They come to your building, warehouse, whatever, and they put on solar arrays, so solar panels and battery storage offerings, and then they kind of control every step of that business going forward. Before we get any deeper, it is worth noting that the company is trading for around $6.20 per share. So that makes it more volatile in the beginning. As I said, all of these stocks are kind of home run plays. But moving on, Altus originates, develops, and owns and operates locally sited solar generation, energy storage, and charging infrastructure across the U.S. A large chunk of the Stamford, Connecticut's based company's operations are currently in the Northeast and in California. The company offers solar solutions for corporate entities, schools, hospitals, nonprofits, and various other areas of the economy. On top of that, the firm's trying to allow homeowners and renters access to solar energy without actually installing rooftop solar, which could be a nice growth area as well. So the goal is to enable customers to, quote, subscribe to larger solar projects built on commercial and industrial warehouse roofs, unused land, carports, public property, things like that. Altus is set to grow as a larger chunk of the commercial real estate market starts to embrace solar energy, with that segment kind of lagging behind solar adoption compared to residential. So residential went through a boom recently, but now maybe we could see the commercial side embrace more of these rooftop solar panels, which could be a big boom for Altus. The company matched our earnings estimates in mid-August with its total installed portfolio at around 698 megawatts at the end of the quarter. Plus, the company said it's on track to complete construction of about 75 megawatts during all of 2023, and it said is now the largest owner of commercial solar arrays in the country. Altus is projected to see its adjusted earnings slide in 2023. That said, this came after they slipped heavily in the first two quarters, so Wall Street's already looking ahead with Q3 and Q4's outlook pretty solid at the moment, and then it's projected to surge from 6 cents per share this year all the way up to 14 cents per share next year. And meanwhile, it's projected to grow its revenue by 70% in 2023 and then another 53% in 2024 to pull in $260 million. And its shares have jumped about 15% in the last 3 months. This tops the recently surging Zacks energy sector and the S&P 500. And this is part of a 40% climb since early May. As I said, it's trading at around $6.20 per share, which is 50% below its 52-week highs and 78% beneath its average Zacks price target. Altus is currently trading between its 200-day and 50-day moving averages, and it completed the golden cross where the shorter dated moving average crosses above the longer term trend at the end of August. So it could be in a nice technical spot at the moment. Plus 6 of the 7 brokerage recommendations that Zacks has are strong buys, with only the other one sitting at a buy. So overall, Wall Street's pretty high on this low-priced way to gain exposure to the solar industry in a kind of unique area of that market. Once again, disclosure that Zacks Alternative Energy Innovator Service owns Altus Power at the moment. And now we're going to move on to the last of these stocks, and that is Livent, which trades in the ticker LTHM. It's a lithium firm that produces high-quality finished lithium components, and its offerings serve various markets, including pharmaceutical and agrochemicals, industrial, aerospace, and, of course, the booming growth areas of battery for EVs and overall energy storage in the booming area of electric vehicles and renewable energy. Livent and many other lithium companies are benefiting from the rapid expansion of electric vehicles and renewable energy. Rechargeable lithium-ion batteries are now crucial cogs in the next wave of energy and transportation, and the company also benefits from the ongoing expansion of tech devices such as smartphones and electronics that have been using lithium-ion batteries for a long time. For a quick primer or refresher before we go any further, it's worth just kind of quickly understanding lithium for anyone who might not know. So the U.S. Department of Energy's straightforward synopsis of lithium is that it's, quote, used for a relatively rare earth metal. Lithium is a soft, light metal found in rocks, subsurface fluids called brines, on and on. And then it is a major ingredient in the rechargeable batteries found in your phone, hybrid cars, electric bikes, and even large grid-scale storage batteries. So this might be a little bit dated since it's now heavily in the EV space, but that gives you a sense of what lithium is. The prices skyrocketed between the summer of 2021 and November of 2022 as traditional auto giants and startups all raced to roll out EV offerings to compete against Tesla, which is the top dog at the moment. But prices got overheated due to a combination of speculation and demand. So lithium prices are now down around 65% from its peaks and hovering around where they were in late 2021. So kind of back to more stabilized levels. Despite the possible boom and bust cycles, lithium demand is projected to outrun supply for years and years to come. Just think of how big lithium-ion batteries are for cars when they used to be only used in your smartphone. Now that battery pack is sometimes as big as the entire base of the car. So the company reaffirmed its 2023 guidance range last quarter, and it expects the second half to be broadly similar to the first half. So this is despite these lower prices, and its guidance is based on, just the fact that the market's stabilizing and the long-term outlook remains really strong. The company's revenue is projected to climb 32% in 2023 to $1.1 billion to help boost its adjusted earnings by 54%. And its sales are then projected to jump another nearly 30% in 2024, with earnings set to climb another 20%. And this comes on top of 93% revenue growth last year and 45% top-line expansion in the year before. So able to continue to churn out impressive double-digit growth, even as it came up against that massive bottom-line growth over the last several years. It's also worth noting that the company proposed a merger with Allchem. It's moving forward. The hope is that it closes at the end of the year. It's an all-stock merger of, quote, equals. It announced it first back in May and will create the world's third largest producer of lithium. As a reminder, Livent shareholders will own approximately 44% of the new public company. As I said, that deal is not closed, so just worth noting that in the background. Overall, the stock's up about 115% in the last 3 years, but it's chopped around since the early part of 2021. And it now looks as though it might be able to break out as it found support at its 200-month moving average. And it's kind of now hitting its low point of the last several years. It's kind of hit these levels a couple times and then bounced back up. It's trading 55% under its average Zacks price target and 42% below its own highs. And it's also right at oversold RSI levels. On top of that, it trades at 8.1 times forward 12-month earnings, which is a discount to the broader Zacks sector that it's in, and a roughly 95% discount to its own insane levels that it reached. And it's actually near its all-time low. So if you are in the business of looking for a lithium stock and you have the idea that lithium is still going to be a big role, it's certainly worth considering Livent. And once again, I own this stock in the Zacks Alternative Energy Innovator Service, along with around 15 other stocks in the broader renewable and alternative space, from nuclear to solar to hydrogen and beyond. So all these are home run style plays that are worth considering at the moment, that are trading for under $25 per share, some well under $25 per share. So that does it for this episode of Full Court Finance. Until next time, I'm your host, Ben Rains. And remember, if you have any questions, please feel free to shoot us an email over at podcast@zacks.com.
This material is being provided for informational purposes only, and nothing herein constitutes investment, legal, accounting, or tax advice, or a recommendation to buy, sell, or hold a security. Do not act or rely upon the information and advice given in this podcast without seeking the services of competent and professional legal, tax, or accounting counsel. Publication and distribution of this podcast is not intended to create, and the information contained herein does not constitute an attorney-client relationship. No recommendation or advice is being given as to whether any investment or strategy is suitable for a particular investor. It should not be assumed that any investments in securities, companies, sectors, or markets identified and described were or will be profitable. All information is current as of the date herein and is subject to change without notice. Any views or opinions expressed may not reflect those of Zacks Investment Research as a whole.